Roads of Illinois serve to farmers and ranchers in central Illinois and the Midwest. Today's edition of Back Roads of Illinois. We were bringing you lasted for farming sources and information sponsored by AgriGold. We're glad you're here on a Wednesday afternoon. I'm Cesar Delgado. I am your host of today's program. We're having a lot of news to cover the agricultural industry in the Midwest, like with ag labor, Iran and Israel war, wheat harvest season for in the plains and the Midwest. A lot of stuff going on with the world for right now. And then we were going to talk about the commodities markets with Brian Basting from Advanced Trading. Otherwise, this is your rural news sponsored by AgriGold. Ag markets and counting on the beans markets are up for the RVO from EPA. The biofuel industry are glad to have the mandate to be clear about the biofuel industry for the soybean. The USDA are checking for the New World screwworm outbreak for Mexico. The Secretary Brooke Rollins will send the veterinarians and other officials in Mexico. Finally, that the fertilizer markets are watching for the war in the Middle East. The fertilizer prices are currently down for right now. Also, the oil prices are going to be up for export from Israel and Iran. This been your rural news sponsored by AgriGold. We were talking about the commodities markets with Brian Basting from Advanced Trading. And then we were listening to Patrick Deathman from Gas Buddy on the gas prices with the conflict in the Middle East.
There's been headlines in the Middle East really for the last couple of years as well. In addition, OPEC increasing oil production, just a lot of different factors that could weigh and offset on oil markets globally. So there really has been quite a busy time for oil and energy markets to digest all of the various news that's emerging.
Iran and Israel war and the 4th of July, our economy. Gas prices are falling into the cheaper than from last year. Gas buddy Patrick Deathman, he explained that the gas prices are falling at the pump across the country.
Gasoline, diesel prices remaining at some of the lowest levels for this time of year in several years, but there likely will be some impacts to gas prices and diesel in the week ahead as the jump in oil from last week is started to be pushed down to the retail level. But those increases likely will be limited with oil prices now showing a big decline today of nearly 4%. So any increases that motorists and consumers of diesel will see here in the next few days will likely unwind as we get closer again to July 4.
Patrick Deathman added, OPEC has increased their oil production in the Middle East. Israel has been attacked on their canal on June 21st at Iran. Gas prices are currently lower than previous years, and the oil production in the historic numbers by OPEC. Thanks to Glenn Vaughn from PNW Ag Network for this audio. This is your commodities markets update for this afternoon, sponsored by Kyle Bumstead from Allendale Incorporated. July corn is up at 3 to 6 quarter. September corn is up at 4 to 8 cents. July beans are down at 5 to 10 cents. November beans are down at 3 to 6 cents. March beans are down at 4 to 8 cents. Kansas City wheat is up for today. September KC wheat is up at 3 to 5 cents half. May KC wheat is up at 3 to 6 cents. Chicago July wheat is down at 8 to 6 cents. Chicago September wheat is down at 5 to 10 cents. Livestock markets are mixed for today. August cattle is down at 8 to 6 cents. October cattle is up at 9 to 5 cents. July feeder is going to be gone for this year, but August feeder is up at 9 to 4 cents on quarter. September feeder cattle is up at 5 to 10 cents. August hogs is up at 5 to 10 cents. October hog is down at 3 to 6 cents. This been the markets update. Well, it has been a wild summer and grains fundamentals are volatility for right now with the Middle East and the wheat harvest season in progress. We were talking about the commodities markets with Brian Basting from Advanced Trading. Brian, how are you?
I'm fine, thank you, Caesar. How are you?
I'm glad I am back from my vacation since June.
We're glad you're back too and hope you enjoyed your vacation.
I've been out since June 16th, but it's been pretty hectic with the commodities markets, especially in uncertainty within the Middle East. Brian, do you have any thoughts on the fundamentals on the grains with these world events?
I think we're looking at a market right now, Caesar, that's looking at the potential, underline the word potential, for record corn yield here in the US. And that has overwhelmed or overridden, if you will, any other news that we're seeing, whether it's in the Middle East, whether it's in the Black Sea, whether it's regarding tariffs. The market has just been overwhelmed by the uh, fine crop condition ratings that the USDA has published. And we had some more rain, for example, here in central Illinois yesterday, areas that were dry. Some areas, not all areas, but some areas that were dry caught some rain. So I would say that those other factors, Caesar, are important. They can still be market movers over time, but right now the market is trying to get its arms around how big these crops could be. And for the moment, it's taking the most bearish stance, excuse me, from the standpoint of favorable weather, favorable crop condition ratings. And the forecast just came out this afternoon is cool for the next 2 weeks across most of the Midwest. So that's another favorable factor.
Do you have any concerns about the technicals buying and play out for the corn markets?
I think any time that you have an overwhelming push to one side or another, bullish or bearish, you need to have some caution. That doesn't mean it can't keep going lower in this case, in the sense that the funds, the speculative sector now is short the corn market. We did see how strong that could be, though, in the past, in terms of how far the market could go lower with the funds on that side of the market. So I don't want to give the impression that I don't think the funds could not add. I think they could add to their short positions. But I think anytime that you continue to add to that, you reach a point where the market reaches, and I don't know what that value is, reaches a value level where they will where you'll get some buying interest. Obviously, we haven't seen that level really sink in yet. We did see a little bit of covering today on the September futures at $4. but it ended up falling short at closing at 399 and a quarter for September.
Through Brian, we will see for next couple weeks.
I would say, Caesar, the most important thing is the short term, is the Friday supply demand report from the USDA. There's a small camp that thinks we may see an increase in the corn yield in Friday's report. Typically, they do not increase the yield, which is a trend yield, of course, in June, in the July report. The USDA does not increase it unless we see some really good crop condition ratings. So it's possible we could see an increase, but I think seems the consensus is that the USDA will leave that number and make any adjustments in August. But for Friday, the market will still be looking at any adjustments to the old crop balance sheet, specifically looking at exports. We think the export forecast for old crop corn is going to be higher on Friday, but that could be offset by reduction in feed residuals. So I think once we get past the report at 11 o'clock Central Time on Friday, the market will come right back to trading weather, and we'll see what the weekend forecast looks like. The extended forecast looks like going into the weekend at that point.
Of course, the corn is looking good though.
The corn is looking good at this point. Again, 74% good to excellent. There's only been a handful of years where in early July, since those good to excellent ratings started in 1986, there's only been a handful of years where that number has been higher than that. So it's not unprecedented, but it is well above a historical norm for early July. So yes, it's not universal, as I said, even in parts of central Illinois here, as your listeners know, have been dry. But the corn is holding up remarkably well, I would say, despite that dryness, because we're fortunate, of course, to have some excellent soils here in central Illinois.
How are things with the wheat harvest in southern Illinois because of the weather?
The harvest has been quite rapid recently. It was some concern earlier this summer because of the wet conditions, but the harvest itself, USDA put to Illinois at 87% as of Sunday, July 6th. Last year at this time, Illinois was at 92%, and the 5-year average is 87%. So we're slightly below the 5-year average in Illinois, but with the weather forecast looking like it does, I think that the forecast, or beg your pardon, the harvest should be wrapping up within the next week to 10 days for the most part throughout Illinois.
How is the wheat yield with the rains in May, Brian?
Bean export program winds down later this summer, early fall.
The cattle on feeds report is a little bit up for June. However, how compare prices for the feeder cattle since January until now on July 9th?
The cattle market is setting records as you and I speak here. We are looking at the highest feeder cattle prices, futures prices ever. The live cattle futures are making contract highs as we look at the market today. The possibility exists for the live cattle to also come back and challenge those contract highs, all-time highs that we saw back there. Oh, I guess it was back in or mid-June, around $225 to $228 on the futures market. The August contract, of course, is the lead market now. We did see a contract high today in August, but it's still about $8 or $9 below that all-time high. But the fundamentals are just so strong right now for beef. We continue to see very strong box beef prices. So demand is there from the consumer for the moment. Eventually any price will get too high for a consumer to afford. We have not found that price yet for supply and demand. Uh, we will keep an eye on exports as we move forward. I would caution your listeners on one thing. There's always that possibility in any market of a black swan event. By that, I mean some catastrophic event that would really stop, let's say, beef exports. In 2003, 22 years ago, we had a discovery of mad cow disease here in the U.S. Only one cow, but we lost all the export market to Asia for a number of years. I can't predict that, of course. I just say that with prices this high, the market is more vulnerable to some bad news like that. So I just encourage your listeners to continue to exercise risk management and be wary of those things because they are always lurking out there. And unfortunately, sometimes they show up when we least expect them.
Do you have any concerns about the consumer budget might be not going to have some beef for the future with credit card is looming?
It's a great point. I do have some concern. I do. The consumer is hanging in there for now. All evidence is suggesting that. But I think your point is a good one, is that perhaps some of that ability to uh, meet the bills, pay the bills, continue with the purchases that they're used to is being put on the credit cards. I think that we have to be cautious moving forward at these really high. We're looking at the highest prices for choice beef since the pandemic, since the spring and early summer of 2020. And I do believe it's something to be aware of and be cautious about. That there is a point, and again, I do not know what that point is, but there is a point where consumers will not pay for what we see. I don't know what that point is, but for the moment, they are hanging in there as such. And this is the prime grilling season in the summer. Of course, we just had the July 4th Independence holiday, and we've still got all summer and most of the summer anyway. So, well, again, just caution. And I'm not. The sky is falling, and the market's going to fall apart. But I just think we have to be cautious. And your question was a very good one.
What is your final thoughts about the fundamentals with the commodities markets, especially in uncertainty with geopolitics?
Thanks for having me on your program. I always enjoy hearing your thoughts, and I think you've been spot on today on a number of issues. My final thought would be that I think from a producer standpoint, I'll start with the grains. From a producer standpoint, the uncertain geopolitical situation, the uncertainty surrounding tariffs, the uncertainty surrounding the economy, the uncertainty surrounding the potential of trade deals. I think I'd encourage your listeners to remain as flexible as possible in the marketing and avoid uh, painting themselves into a corner, as it were, with a strategy. You want to provide a floor for your expected production and any remaining old crop inventory that you have, but you also want to leave the upside open. The reason I say that is if, for example, we were to have a major trade deal struck somewhere with China, perhaps something similar, again, not a prediction on my point, but if it were to be something similar to that, I believe it was called phase one trade deal that we have with China back there in 2019, 2020. I can't remember exactly when, but basically China came in there at that point and bought substantial quantities of U.S. corn, and it helped underpin the market. And that would change the whole outlook here for our exports in 25, 26 that I described earlier. That would that would be a wild card because right now we don't have much penciled in for China for next year. But trade deals, geopolitical, all those things are wild cards that make flexibility important for grains. So eventually the market will find a bottom here where we will encourage usage and we will discourage acreage. Obviously, our crop is already planted here, but at some point, the market will get cheap enough where foreign producers won't want to produce grain. The first place that would be seen, of course, now would be in the southern hemisphere, down in Brazil and Argentina later this calendar year. So just be cautious, be flexible. And on the livestock side, I just say on the opposite side, it's so bullish right now on cattle, for example, that I really want to maintain a mentality where you defend your balance sheet. And you say, what does he see? What does he mean? Defend my balance sheet. It means we got record high prices for cash, or near record high prices for cash cattle. Obviously, the feeder cattle are right there now too. So but the good news from a cattle standpoint is that the cost of grain is low. So I would remind the folks with cattle is that perhaps you want to be looking at putting a ceiling on your feed input costs. If you're buying corn or soybean meal, one option possibly, in my opinion, would be to purchase a call option at these lower prices to keep a ceiling. Leave the downside open in this case, but keep a ceiling in case we get a trade deal or something and the market were to take off. And then just be very wary with the contract highs we're seeing of just just be careful up there. Again, I'm not the sky is falling, but I think that we have to be careful that anything can happen when you hit these levels. So defend your balance sheet with the marketing tools available to you.
Of course, Brian. Brian, this is a follow-up. I've been traveling from a past month. I see more soybean acreage than corn, but I want to have your position on this. What is your thoughts on the balance sheet on this year?
I think it wouldn't be a surprise, Caesar, to see a slightly larger soybean acreage number down the road. The soybean price wasn't necessarily great by any means, but I think maybe we did run out of some time to plant soybeans in June, and maybe a few more double crop acres. Here's what I'd share, Caesar, on the soybean balance sheet. I think when you look back at history, and we're looking at some private estimates out there now, a lot of private estimates are penciling in record corn yields. And I think that's a possibility this year, but they're not penciling in really the type of strong record bean yields. And I think that's based off of, as you and your listeners know, the weather trends that tend to favor great corn crops don't necessarily favor great bean crops. Without going too far down that road, that's just our observation over time. Rarely have we ever seen tremendous corn yields and tremendous bean yields in the same year. We can see one tremendous yield for corn, for example, and a pretty good bean yield. But here's what I'm getting at. If you assume that that's a possibility here in 2025, that maybe the bean yield is just good and not great, that with the reduction in bean acres this year compared to last year, if we were to see a August weather issue in beans that doesn't necessarily affect corn too much, but affects the bean yield and takes it down a bushel or two, the bean balance sheet for 25, 26 could get tighter than what it is penciled in today. So that's the one thing I'll share, is that remaining flexible is important, because the beans are not made in July. Bean crop is made in August, so we still got a long way to go there. For corn balance sheet, the biggest variable I can give you today would be some type of trade deal, because I think the yield with each day that passes, it's not made yet. I don't want to give that impression, but each day that passes in July, we certainly have a better chance for a bearish balance sheet on corn. But the market's built in some of that too with $4 in September futures. So bottom line is, I think the balance sheets for beans could be a surprise if we were to see not even a drought, maybe in July or late July or August, but maybe just take that yield down from 52 and a half, maybe to 50 and a half or 50, something like that. It'd be just a little bit below what we saw the last couple of years. Then you get some interesting changes in the balance sheet there.
Sure thing. Thanks, Brian.
Thanks for having me, Caesar.
This is Brian Basting from Advanced Trading One Back Roads of Illinois. Thanks to Brian Basting from Advanced Trading for today. I am Cesar Delgado. You have a good day.